Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Monday, 25th August. Coming up on the show, the Powell effect. How are the markets reacting to the Jackson Hole speech? Nvidia reports earnings this week. I speak to the boss of a London-based AI startup backed by the tech giant. And I'll tell you why property stocks both in the US and China are on the rise. So grab your coffee and let's own the morning. The first thing you need to know is that the world's largest company and AI leader, Nvidia, will report earnings this week. On Wednesday, after the closing bell, the tech giant's results are likely to test a summer rally that has stocks back to near record highs. The earnings report is also likely to give investors more clues about demand in the AI and semiconductor sectors. Analysts are expecting sales to hit another record high despite an anticipated hit from export curbs. Remember, back in May, Nvidia warned that it could face an $8 billion hit from China export restrictions, though it recently struck a 15% revenue sharing deal with the Trump administration. The main event on the economic front, though, will be the PCE data. And that's coming out on Friday. It's the Fed's preferred measure of inflation. Now, the PCE, the core PCE and the main readings are forecast to have risen by 0.3% month on month in July, the same pace of growth in June. Now, the next thing you need to know about is that Keurig Dr Pepper will buy the Dutch coffee company JDE Peet's for $18.4 billion in cash. That makes it a 20% premium to its stock market valuation at the end of last week. Now, the Dutch listed shares of JDE Peet are on track for their best day on record. The deal means that Keurig Dr Pepper will split its coffee business from its other beverage operations. It will then separate its units into two independent US-listed companies once the deal is complete. Now, consolidation among food and beverage companies has been ramping up as businesses grapple with shifting consumer preferences, inflation, and surging commodity costs. And finally, Jerome Powell's final ever Jackson Hole speech had quite the impact on the markets. The Dow surged over 800 points, the S&P 500 finished the week just shy of a record high, and the Nasdaq climbed almost 2% higher on Friday. Investors clearly believe that the Fed chair signaled that rate cuts could start as early as next month. And globally, the impact has also been felt. Asian stocks followed Wall Street's rally as investors in the region felt the comments by Powell were dovish. Tech stocks in Hong Kong led the way, with the Hang Seng Index closing close to its highest in 4 years. Mainland China's blue chip index in Shanghai rose for a fourth straight day and in fact hit a 37-month high earlier in the day. There were strong gains in South Korea and Taiwan too. But is the market reaction justified? Well, who better to ask than Jim Bullard, a former St. Louis Fed president. He spoke to my colleague Jennifer Schoenberger shortly after Powell finished his speech.
I thought it was carefully done. He laid out the case for rate cut in September. I thought he did a good job of talking about both the labor market side and the inflation side, and the judgment of the committee that the policy rate is a little bit too high right now, so they can afford to come down a little, and then that will still put downward pressure on inflation, but it will be a little bit less out of line than where they are right now. And so I think markets are reacting definitely to that, with 2-year going down a lot. And then on the framework, I think it was probably long planned that they would use the Jackson Hole speech to talk about the changes to the framework. I thought that was a good discussion as well, that explained what really seemed like very moderate and logical changes to the framework based on a long discussion that went on for more than a year.
And do you see this as laying the groundwork for a one-time cut of 25 basis points come September and then sort of wait and see and assess? Or is this the kickoff to what could be more of a rate cutting cycle?
Well, in June, the committee said that the median of the committee said that they expected 2 rate cuts by the end of this year. So this would keep the committee on track to have that as an option. They can certainly digest the data as it comes in and decide what they want to do with both the October meeting and the December meeting. But, there's nothing special about the end of the year. They can go into go into next year. I've said that over the next year, it could get as much as 100 basis points of reduction in the policy rate if the data continues to cooperate and inflation comes down slowly toward the 2% target.
Time for some trending tickers now. And first up, Ørsted. The Danish energy giant is seeing its shares tank around 16% this morning. The latest blow for the wind power company came from the US government, which issued a stop work order on its offshore project off Rhode Island. Construction already 80% complete, with 45 of 65 turbines installed. Must halt while regulatory reviews continue. The firm said it's still pushing ahead with a massive effort to raise more than $9 billion through a rights issue as it struggles to navigate a new reality under Trump. Just look at this chart. Ørsted is down a staggering 45% year to date. Now, here's a booming stock for you. Dongfeng Motor Group. It's jumped as much as 69% this morning. It's now up around 54%. But you may not be able to buy this stock for much longer. The price rise follows the announcement that Dongfeng's parent company wants to take the car maker private in a deal pegged at around $7 billion US. The plan would be to create another listing for its luxury electric vehicle unit, Voya, as Dongfeng pivots to EVs to counter the rise of BYD and other market leaders. Now, just take a look at this chart. Dongfeng shares had been dropping since 2021, but in the past 12 months, they're up more than 350%. So anyone who was on the right side of this trade must be celebrating today. And one more trending ticker for you, Intel. It keeps hitting the headlines and the stock is now buzzing with lots of shares being traded in the pre-market. It's up more than 1% this morning, which comes up on top of a 5.5% rise at the close on Friday. Intel is now benefiting from the announcement that the US government has taken a 10% equity stake, converting existing grants into stock. But of course, as the world goes these days, it isn't clear yet what the government deal means for corporate governance. Just a couple of weeks ago, Trump attacked the CEO of Intel, Lip-Bu Tan, but everything changed after the two men met, and the president is now framing this deal as a patriotic boost for the struggling chip maker. Okay, it's time for a quick break. We'll be back with our exclusive interview with the CEO of a rising AI company that's backed by NVIDIA. Welcome back to Market Sunrise. Well, NVIDIA will take centre stage this week when it reports its quarterly earnings after the closing bell on Wednesday. One firm that it has backed is the London-based AI startup Synthesia. It uses AI to create lifelike video avatars based on humans, which can be deployed in a range of scenarios, including customer support, sales and staff training. I spoke to the CEO and founder, Victor Ripapelli.
Synthesia is the world's largest AI video platform for businesses. And really what we do is very simple. We help businesses all over the world, big and small, communicate in video, which is very important in 2025, right? People want to watch and listen to their content. They don't want to read as much as they used to. And it simply is just table stakes that you can communicate in video today. Now, instead of having to run around with cameras and actors and studios and microphones, all the things you usually would need to make video, with the Synthesia platform, we do all that with AI. So it's kind of like making a PowerPoint deck. You go in, you select one of these avatars, you create one of yourself, then you type out your script, you finalize the rest of your video with some kind of editing, and then you have a video that's ready to go. So what we're seeing people use this for is everything from product marketing videos, customer support, internal training, sales development, and a whole bunch of other use cases. But the goal is to educate or share some kind of message, and they want to do that in video.
Now, I know that recently you've been working quite a lot on translation. Can you explain what exactly you'll be doing and how it will work?
Yes, we also have another product which is called the AI dubbing. And AI dubbing is essentially you take a real video. So that could be any video recorded at any point in time. You put it into our system and you tell us that you want that video in French, Mandarin, Spanish, whatever language your heart desires. And then what we'll do is we'll take the video, we will clone the voices in the video, and we will change the lip synchronization so that it looks like you're actually speaking a different language without you having to do anything. So it maintains the tone of your voice. It's actually you speaking in a different language. And it's essentially a one-click operation. And this is really popular for companies who take the existing library of all the videos they've created over the last many years and instantly enable them for a global audience.
Now, you spoke earlier about avatars, and I know you're working on a next generation avatar, but actually how useful is that for business?
It's very useful. Anyone, I think, who's been involved in making a corporate video, even if they look very simple, someone just talking to the camera, I think most people can emphasize with the amount of kind of pain that goes into it. The whole production process of setting up cameras, so it takes a lot of time and money. And then, often if you're an executive, you have to do your lines 15 times because, you can't remember them or, you don't feel like you said it in the right way. Everything here is much easier with just like typing it out. And so what we're seeing is just that when the kind of productivity gain is on a scale of like 100x to 1000x of using normal cameras, there's so many more use cases that you all of a sudden can make a video for you never would have made a video for before, right? And that's what a lot of our customers are doing. You take customer support, most companies' customer support portal has a lot of like text articles that helps customers answer whatever questions they might have. We've seen time and time and time again, if you take all those text articles, you turn them into videos, people can self-service much higher. We work with a really big bank in London where the call deflection rate went up by almost 30% just by adding videos to that knowledge base. And that saves tons of money in terms of call centers, right? So there's so many of these use cases that we unlock because it's so easy to create video.
Now, this is a question I've asked many business leaders. In the AI space, often your products could lead to job losses, especially if your products are as good as you think they are. Is that right?
I think new technology waves always changes the job market as well, right? And I think, potentially being a camera operator in 10 or 15 years is not as valuable a job as it is today. But I think no matter how much AI we get, I think the humans as a part of a business is still incredibly important. So I think jobs will change. There may be some short-term displacement, but I'm not really in the camp of people who think that, within the next 3 or 4 years, like everything is just gonna like radically change. I think it takes pretty long for people, for companies to integrate these technologies. Most of these technologies are not good enough at all yet to necessarily replace someone. And I also think what's going to happen before that is you're going to augment people, right? So maybe if you're, a recruiter and you're using agents to screen people instead of junior candidates, maybe instead of one recruiter being able to have 5 calls in a day with candidates, an agent can have 100 calls. And then the junior recruiter can sit and look through all those 100 call recordings to figure out who's the right person for this job, right? So I think it's too simplistic to just kind of assume that because AI can do customer support, that those jobs will just sort of disappear.
And recently we've been hearing a lot of noise about the fact that maybe the AI hype has been overblown. What's your response to that?
I think there are definitely a lot of hype, and I think there are definitely a lot of companies that have taken in lots of funding that probably is not going to go anywhere. But I think on the other hand, right, it's very real, right? AI is going to transform everything we know about how we work, live, and play. This is not virtual reality and the metaverse, right, where it kind of all fizzled out and didn't really have too much impact in the actual world. I think it's very, very clear if you just look at just the people that you know around you, right? How many people use ChatGPT as part of their job or as part of just their daily life? The value is very real. The way that these new technologies usually arrive and integrate in society, right, is that there's tons of money that's blown into lots of different companies. A lot of them are going to end up dying, but there's going to be a few of them that's going to end up really kind of creating value and changing the world, right? And so I think this is as real as the mobile boom when we saw that, like 10, 15 years ago. It's as real as the internet, 20, 30 years ago, and it's as real as computers when they were first invented. It is definitely one of those waves that's going to hold water. But in the short term, I think there's going to be a lot of investors that lose a lot of money.
So Victor, earlier your company was valued at $2.1 billion when you last raised investment. Nvidia is one of your backers. Adobe has just invested as well. So where next for Synthesia?
Well, for us, we're humming. Business is growing really, really quickly. We announced a couple of months ago that we surpassed 100 million ARR. We're growing 100% year on year. We work with more than 80% of the Fortune 100. So for us right now, there's lots of innovation to come. We're launching our agent product very soon, which means that instead of just watching videos, you can talk to the video. So if you're watching a training video, for example, you can get quizzed in real time by the video to make sure you've actually understood that content. And so there's lots of innovation that's still happening, but it's also just at the scale right now, right? It's about landing all the customers that we want to work with, helping them become successful, and expanding kind of our contract sizes. I think we're no longer in the chapter of this market where everyone is like sort of playing around trying to figure out what works. There's very real value that's been driven by our product with our customers, and so there's a huge scaling game in kind of running in parallel with of course tons of innovation on the core product and offerings that we have.
Time for another short break, but stick around. I'll explain why property stocks in both the US and China are on the rise. Welcome back. Now, the US and China have one big thing in common this morning, and it has nothing to do with AI. The world's two largest economies are both seeing housing stocks rallying, but for very different reasons. In Shanghai, effective tomorrow, authorities are lifting some restrictions on how many homes people are allowed to buy outside of the ring road. By relaxing these rules in big cities like Shanghai and Beijing, the government is trying to stimulate the market amid sliding prices, and it's doing so by opening up effectively more supply, and other measures such as lower interest rates for buyers. And as you can see, the Nasdaq China Real Estate Index has been rising quite a bit, up more than 4%. Now, keep in mind there's plenty of reasons to be cautious. Many real estate companies are heavily leveraged, and just today the giant developer Evergrande delisted from Hong Kong after years of troubles with debt issues. Moving on to the US for a very different story in the property world. High hopes that the Fed will lower its rates next month are fueling investors' enthusiasm in the property market. The narrative is that we're on the cusp of a housing recovery and real estate stocks are rising. Look at Opendoor. Even if it's lost some ground in pre-market, the real estate platform not only hit fresh all-time highs, but it's up around 58% week over week. So on one hand, lower borrowing costs could certainly be a catalyst for housing demand and related stocks, especially for platforms like Opendoor. But on the other hand, there are many skeptical investors out there who believe that the fundamentals do not justify such a boom for Opendoor, which has been labelled a meme stock, like many others. But how do you decide whether or not a stock is a meme? My colleague Jared Blikre gives you the answer in his latest episode of Stocks in Translation.
Meme stocks are back, and the speculative pulse that we're seeing today looks a lot like the afterglow of 2021. It's not just price action, it's also pressure on management. And on today's Stocks in Translation, we're going to show you the heat, define the phenomenon, and then test it with Opendoor. Now, here behind me is a heat map of today's price action in our meme stock basket that we first created in 2021 with a few updates. We've also seen many of these stocks perk up over the last few months, and there are lots of familiar names here, so let's try to spell out what makes a meme stock. And here we wanted to find the vibe without getting too dogmatic because there are lots of exceptions. But most meme stocks are consumer facing, or at least a familiar name. And when they first appear on traders' radars, they tend to be smaller companies with lower share prices. It also helps if traders are betting against them, so high short interest is another box check, maybe 15% if you're keeping score at home. And the most important criteria probably is heavy retail attention with a rip-roaring good story. Now, here we're looking at a chart of an index of highly shorted stocks from UBS. They're not all meme stocks, but it's a good proxy. And you can see that we recently hit the highest levels since early 2022. Now, we're going to want to watch how high this index climbs from here. But first, let's get philosophical for a minute. Why have meme stocks captured the attention of younger generations? Ed Elson, co-host of the Professor G Markets podcast, lays it out. His frame is very simple. The old menu feels closed. Indexes are expensive, housing is unaffordable, and many of the most exciting companies, they stay private for very long times. He says we are locked out of the upside. So what do? We invent our own asset classes, crypto, meme stocks, anything that offers a chance at returns that we cannot access through traditional paths. Now, let's take a look of a case study here, and we're going to go to Opendoor. Now, look at the year-to-date whipsaw from pennies to mid-single digits. It was down 99% from its 2021 highs, and now it's up multiple hundreds of percents off of its June lows, up nearly 40% today alone. That checks off a few of our boxes. It also helps explain why it's catching major retail attention. And now here's Anthony Pompliano with an interesting take. Pomp says the people calling Open a meme stock don't understand what's happening. Retail investors are now having a hive mind, working together to identify opportunities, take financial positions, and advocate for improvements at target companies. He goes on to say, it's like decentralized hedge funds with individual capital and collective intelligence. Product ideas are surfaced to executives and change is happening. He wraps up saying, the power of the crowd cannot be underestimated. Now it's scoreboard time. Let's measure what retail has advocated for at Opendoor and match it with what has actually happened here. Now first, investors got the CEO switched out for an interim lead from product and tech. Check. They're also getting a renewed focus on AI, so check there too. As to the balance sheet, we'll have to watch future earnings releases to check that box, but bottom line, the executives are engaging publicly, which is not how things used to play out in the old regime. So let's zoom out here and look at the new playbook. Investors are organizing online to surface ideas. They accumulate shares, drawing the attention of leadership. Then they apply public pressure and they turn the screws. And if all goes well, not only do the execs listen, but they implement change. We saw some of this play out at GameStop and AMC, but to be fair, these two stocks have not become anything close to the poster children for turnarounds. So what's next for meme stocks? Or should we say stocks that capture retail imaginations? First, we're going to need to keep tabs on that speculative fever, but you need more than momentum fuel. So does the C-suite actually respond to retail pressures, or do they just give lip service? Because at the end of the day, we want to know if we're all looking at a new activist force or just fuel for short squeezes. And tune in to episodes of Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Great stuff there from Jared as normal. Okay, before we go, let's have a look at where the markets are. We start with Asia. And as I mentioned earlier, Hong Kong stocks, they got quite a boost from tech, up almost 2% on the day. The Kospi there in South Korea also up quite strongly as well, one of the best performing indexes in the region, basically boosted by the fact that those dovish comments by Jerome Powell on Friday at Jackson Hole. Okay, let's turn it over to the European markets now. And one thing to note is that the UK is closed for a public holiday today, so perhaps liquidity is a little lower than normal. In mainland Europe, though, the benchmark stock 600 is falling after closing just short of an all-time record high there, down just 0.15% there. Okay, let's have a look at US futures now, and they retreated as some of the euphoria around the expectations of a Federal Reserve interest rate cut eased, with concerns about tariffs and their impact and inflation and corporate profits back in focus. But remember, the market is still seeing an 84% chance of a rate cut next month. Okay, let's have a quick look at Bitcoin as well. Now, it's falling today. It actually went up to 117,000 after that Jerome Powell speech, but down now despite those dovish comments from the Fed chair. And Ethereum is another one to have a good look at too. It's closing in on its record high, getting close to $5,000. It's actually falling now, but it was getting closer to 5,000 earlier. Okay, that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm sure she'll have more on the Nvidia earnings and a look ahead to the PCE inflation reading too. I'm Ramzan Karmali. Go own the morning.